Right folks, welcome back to the channel. Here we have the Euro USD 4-hour time frame in front of us. Let's just quickly reiterate that. So we have the Euro USD 4-hour time frame in front of us, and I'm going to be going over a quick case study of a trade that was taken earlier in the week and that was given to the members in the private community. So let's get involved. So what we have over here is we have structure that we're going to consider first, and this is one of the first things that I consider when it comes to analyzing the markets on the higher time frames. So what we see over here is we see a structural high over here. So we see a structural high over here at this point here. So we see a bullish break of structure signified by the arrow which I've added onto the chart. This is a bullish break of structure, and then from here we see the swing high up here. This swing high produces a swing low down here. So we've seen a break of structure over here, and now from here we've seen a retracement. So we've seen a retracement up here. We built a ton of liquidity in the process, and now we've broken structure to the downside. Okay, so from here, my overall narrative, if you're following me on Twitter or the free Discord or anything, is the fact that I have an anticipation for price to get down to this POI over here, right? So I expect price to hit this daily POI, which is at the price point 1.0582 roughly. But we need to understand where we are in price, and this is how important the 4-hour time frame is. The 4-hour time frame is an incredibly important time frame when it comes to analyzing the markets, right? So what we have over here is we have a H4 low over here. So this is the last H4 structural low, right? It's very important to mark this out, right? This is the last 4-hour low, right? The last 4-hour low. So now we understand that we're actually just below this low because we've had a break of structure. So this line here represents a clear break of structure to the downside, right? So this is a bearish boss, right? A bearish break of structure, a bearish boss. So now we're below an old low, we're below an old H4 low, right? So we understand from the markets intuitively, right? A lot of us understand this market structure. We have a break of structure to the downside, so we break structure and we have a retracement, right? So what the key of this particular case study is to understand that over here we are in fact below an old low. Okay, we're below an old low, right? So this red region represents a low in the market. This is a H4 low. Now every time we're below a low, it's reasonable to anticipate somewhat of a pullback, and the pullback I'm going to represent in green, and this is a Wyckoff concept. So I'm going to quickly simplify the Wyckoff concept down so people can understand it. When we're below an old H4 low, we expect an accumulation, right? When we're at a premium, we expect a distribution. So what do I mean by that? Is once we've reached a premium, we expect a distribution in this area, right? Distribution in this area, okay? But once we are below an old H4 low, or once we're below a major low, we expect an accumulation. Accumulation is what drives price higher, and distribution is what drives price lower. So now that we're below an old H4 low, this gives us the right to look for buys in the market, and this is how this particular trade was actually taken. We understand that we're below an H4 low, right? So we expect a Wyckoff accumulation, right? Or simply an accumulation in this region. So this accumulation is what happened roughly at this price point, and this is an accumulation just over here, right? We're not sure how far the accumulation will go up, but we understand below a H4 low, a Wyckoff accumulation or simply higher prices is a likely expectation and a reasonable anticipation to have in the markets. So now if we jump down to the 15-minute time frame, we're going to be dissecting how you could have entered this trade on the 15-minute time frame and what the 15-minute time frame actually depicts in terms of its structure. Here we go. So what we had over here is we had a clear shift of structure. M15 structure shifted from bearish to bullish, and here's how it did it. We came down aggressively producing this low. This low produced a high. We've seen this high then go and produce a new low, and this here signified that break of structure. So this gives us an early signal for the fact that we could see a Wyckoff accumulation because we're below a H4 low. So understand all of this price action is happening below a H4 low, right? Below a H4 low. I'm going to label that at the bottom because this is where we look for a Wyckoff accumulation, right? Or just an accumulation for short. A Wyckoff accumulation is something we look for in this region, okay? So now that we've had a break of structure to the upside, we understand that how do we use our Fibonacci tool, right? We use our Fibonacci tool to simply depict premium and discount arrays. And how do we do that? It's really quite simple, right? And this works incredibly and powerful in the daily time frame, the 4-hour time frame, and the 15-minute time frame. And here's how we do it. We simply project the Fibonacci tool from the swing low up to the swing high. Okay, so now that we've seen this high that gets formed over here, this M15 high, or this 15-minute high, we've seen a retracement below the 50% level, and this here represents a discounted low in the markets. So this here represents a discounted low. So we've seen price trade below the 50% level towards a discount, just like this. So this here is our discounted low in the markets. Right here, and I'm going to label that in green. So this here is the forefront of the accumulation. Sorry. On Monday, so this is yesterday, 22nd of April, time of recording 23rd of April. On Monday, we understood that we were below the 50% level. So remember, the 50% level is here. So if I quickly drag my fib tool over, we understand that our 50% level is here in this region over here, covered by these candles at the EQ. So this represents the EQ. So anything below the equilibrium is essentially the discount, right? So this is the EQ, and anything below that is the discount. So we understand that we're in an M15 discount. This is where we need to be looking for buys. Okay, and here is our entry model, right? So this is our main entry model in the market, something I've been through many times on this channel, and I'm going to go through it again so people understand it. But now we're going to be looking at it from a liquidity standpoint, right? So what we see over here is we see an Asian range depicted in orange, right? So we see two main points of liquidity. We see an Asian high, which remains unswept during the London session, right? Notice how price never got up there. So the Asian high is the top red line over here. Notice how these wicks never quite got up there, hence they leave liquidity themselves. And the second point we're interested in is the Asian low, which of course has been swept over here. This red line represents the Asian low. So what we're looking for below the Asian low, once the Asian low has got swept, what we're looking for is an N15 clear market structure shift. So we're looking for a structural high, structural low, structural high, structural low, and then we're looking for a shift of market structure over here. So we're looking for an MSS, a shift of market structure. That I'm going to label in black, and we're going to label that MSS, or market structure shift, right? One of the key aspects of the AMD entry model, right? So we start here with the Asian range, and we understand this is the accumulation of the market. So this here represents the accumulation. Now this accumulation, right? After the accumulation, we see a manipulation, right? And the manipulation is typically referred to as the Judas swing. So if we look at it diagrammatically, we understand the Judas swing is strategically placed below the Asian range low. So you want to ask yourself, what is the purpose of this price action over here? Why does the market sweep the Asian low to go higher? What is this Judas swing, and what does it do? Well, this here is the manipulation of the market. So if I quickly bring that to the bottom, this here is the manipulation of the market. Think of the market as tricking sellers into the market when it wants to go higher, because it's building liquidity and it's sweeping liquidity off people before heading in the intended direction, which is bullish. So you want to ask yourself, how can we utilize the Judas swing to our advantage? Well, it's important to understand that there are a couple of rules when it comes to identifying the Judas swing, right? And we're going to go through them now here with live price action. So what we've seen over here is we've seen a structure presenting itself in this way. So we've seen a structural high up here. We saw a structural low, structural high, and a structural low. And it's at this point that we've had the MSS, so the market structure shift, or the MSS, right? So the MSS has occurred here in this region, MSS. And notice how this diagram over here gives us our Judas swing the same way that this diagram did. So let me bring these two diagrams together. We understand that this is how it works. So you've had accumulation, the Judas swing represents the manipulation. So now we're in the manipulation phase. This here is the ICT Judas swing. So the question I often get from students I have is, oh, Liquid FX, how do you actually determine the Judas swing or the manipulation, right? How do you actually determine it? How do you not get swept out? How do you know it's a manipulation? How do you know it's, how do you know this is going to be the true manipulation? It's not a sweep of liquidity. It's not a breaker structure. How do you actually find out? Now, from a probabilistic standpoint, not all of your Judas swings are going to be correct. That's something you need to understand. But from a technical perspective, what validates a Judas swing, or what makes a Judas swing high probability, is a few things, right? So what makes a valid Judas swing, right? There's a few things. The first thing is that the Judas swing must lead to a shift of structure. It must break some kind of structure. It must lead to a market structure shift. So you want to see a market structure shift. That's the first and arguably the most important thing when it comes to Judas swing identification. Now, the second thing you want to identify when it comes to a Judah swing is that the Judah swing must occur during a specific time window, right? So we're looking for time-based manipulation, right? In one of my previous videos, which I recommend checking out, is that we look for time-based fair value gaps, and we also look for time-based liquidity sweeps or time-based manipulations in the market. That's one thing we look for. Now, the last thing we look for in the Judah swing is that the Judah swing itself must leave an inefficiency or a fair value gap. Okay, so this is what actually validates a Judah swing and makes it high probability. This is what makes this Judah swing here a valid Judah swing, right? We look for a shift of market structure, we look for a time-based manipulation, and we look for a fair value gap. So these are the three things that we look for that validate our entry model. So from here, the next thing to understand is that our job is to key off a fair value gap here in this region, right? So where is the closest fair value gap? Well, the fair value gap is marked just here in this region over here. So I'm quite conservative when it comes to my entry models. I understand there's a fair value gap below, but I'm a type of trader who likes to get in and out. So if I can catch the nearest fair value gap and catch a 1 to 1.5, a 1 to 2, 1 to 3, etc., I'm happy to do that. Right, I understand people could enter over here, but my specific entry for this trade and the way I like to trade based off some of the data I've collected is the fact that you want to enter just above the vicinity of the fair value gap. Now, another question I often get is, where's a safe stop loss? Well, you don't want to be too greedy when it comes to your stop loss, in the sense that you don't want to catch too much of an RR. You don't want to aim for these 1 to 6s, 7s, 8s, which are unrealistic, especially in ICT trading. So a safe place to keep your stop loss is essentially below that Judah swing low. Right, you know, a couple of pips below the Judah swing is a safe place to keep your stop loss. And now the next question becomes, where do you target in this market, right? Where is the target? Well, if you remember early on in the accumulation phase, going back to the accumulation, we understood that there was an area of liquidity which was left unswept, and it's the Asian range high, right? ARH, I'll say for short, sorry, Asian range high. So this Asian range high has been left intact, right? As in, we're going to target it, right? The trade was built off targeting the Asian range high. And that's exactly what the trade actually did. It played out beautifully, giving us a 1 to 3 or 1 to 2, I believe. Just up to the Asian range highs, just under a 1 to 2. But if you're targeting, of course, we have a weak structure up here because this structural high hasn't made a structural low. So if you're going to target the end of the range, that's a 1 to 3 yard trade, just under a 1 to 3 yard trade, right? That's a fantastic intraday trade that played through into Tuesday, using the concepts of accumulation, manipulation, and distribution. So we have accumulation over here. We have manipulation in the form of the Judah swing. And we understand when we key off a fair value gap, right? Once we key off a fair value gap, right, and we're catching the move, this is essentially distribution. And this is how ICT can be applied to any particular market, right? Any particular market works off this same principle of accumulation, manipulation, and distribution.